Move fast, break things, and clean up afterwards. That's a very common motto in high growth, fast paced companies, scale ups, and startups, and everything in between. We see a window of opportunity. We rush into it. We deploy capital. We build new markets. We expand into new geographies, into new products. And we see some early traction. We see some success. Sometimes the fact alone that we were able to start something new, to get a presence in a certain industry market or geography, is already success enough for us. It goes on our slide decks. It impresses the investors. It impresses the public in our PR releases. We open an office in X, in Y. The only issue with this is there is a clean up later part. And as somebody who has been involved with the clean up later a couple of times, I have a few thoughts around this. If you start building across multiple markets, if you expand, it is obviously something that shows success, or at least an impression of success. It means that either investors trusted you, that in your home market, you did a really good job, they trusted you with more capital, and they now want you to actually bring that model into new markets. So it is a validation of your business model. It is a validation that you were doing something right. Or it is that some new opportunities just popped up because of market changes, maybe even regulatory changes. Some new rules were implemented in a certain market, and you are uniquely positioned to take advantage of them. In reality, though, most of the time, the initial enthusiasm ebbs off once you face very unique challenges in those new markets, especially if they're in different geographies. You are dealing with entirely new HR policies, labor laws. You're dealing with different regulations in regards to your product, maybe even to your sales process. And now what looked like, a fast success, we open an office here, becomes now a long journey of fixing things, of overcoming challenges, and it starts feeling really heavy over time. On top of that, you'll be facing another challenge, which is you're most likely hiring local leaders in each of those markets. And those leaders, if they work with a company that has just grown really fast, are typically more on the risk taker side. These are strong personalities. These are people who know what they're doing. These are people who don't like to be told what to do. They understand their market. They do not want babysitting. They do not want to be told what to do, and completely understandable. These are competent leaders. They have been in different industries in their geography. And what happens as a consequence is, as an HQ, as a central leader, you'll have a very hard time leading those people. They will, of course, do a good job. They will give it all. They are dedicated to the core mission. They are dedicated to the success of the company. But by design, they also have incentives to keep things a bit more autonomous and disconnected from the rest of the organization. That gives them more room to maneuver. That gives them more autonomy to do things, to shake things, instead of waiting for approvals from HQ. Now, we go a bit back into the analogy of early stage companies being like pirate ships. You move fast, you can turn around 180 degrees at a whim, and all of this gives you success, and all of this is a recipe to success at a certain stage. But once that initial success is proven, you now move into the world of you have to structure all of it so it has endurance, so it has sustainability, so it keeps being successful, and is not just held together by the force of personality or willpower of a few key individuals. When dealing with multi-market setups, I myself have been involved with this multiple times, especially in high-volume B2C industries. You will find that initially, many founders tend to be very controlling, be very much involved with those markets, and rightly so. It's their capital at stake, it's their reputation at stake. Well, you will find founders or top management leaders from the central HQ will try to dictate local decisions. There might be a central VP of marketing who says, I need your brand to look a certain way. I need your digital performance marketing to be a certain way. I need you to spend on those channels. There might be a central VP of sales or director of sales who says, I need you to follow exactly the sales method. I need you to follow this script. I need you to call clients at a certain time of the day. And of course, all of this starts, it raises eyebrows among the local leaders. Why are you telling me what to do? I understand my market better than you do. And the initial micromanagement, the initial control, after a certain time runs into resistance by the local leaders who say, hey, I'm very dedicated and committed to this company. Love what we're doing. I want to be as successful as anybody else here. But these overbearing directives are not going to work for me. I need to have the freedom to act based on what I think is best in my market. And then typically you see a dynamic where the HQ backs off and says, okay, neither do we have the bandwidth, nor do we have the patience right now to run into conflicts and confrontations with all those local leaders. So let them do. And so you will see a wild swing from very heavy centralization towards often an overcompensated decentralization. So now the markets run by themselves. And initially you will see a lot of success with this. Those markets will bring you great numbers. They will show you that the trust is earned. And you're happy about, okay, it's even better. I can be hands-off. I can focus on other topics, can focus on my investors. I can focus on my home market, on R&D, on the product developments. And this just runs by itself. I mean, it gives me peace of mind. Isn't that a good thing? Now, initially, like many things, there is a certain enthusiasm and there are certain successes. But as time progresses, it is often inevitable that challenges will arise. Suddenly it turns out that some of the numbers that were reported are not really correct, or certain numbers are not even available. Over time, it turns out that certain markets, when they report numbers, they actually use different calculation logics to calculate those numbers. And so now if the central team looks at what is going on in those markets, it becomes very challenging to actually benchmark and understand, is the market profitable? Is the market giving me the results I'm looking for? Are the investments, are the budgets that we deploy actually giving us a good return on investment? Maybe we have the next funding round coming up. The investors are asking us for data. We cannot fully trust a lot of the data because a lot of it is self-reported. We never bothered about building a central system, a central data reporting team, because there would have been micromanaging, right? And so what happens then often in those moments, and you add to this high employee churn, suddenly one market faces a barrage of negative reviews by former employees who speak about toxic work cultures and harassment and all kinds of things. And you notice, okay, something is off. But every time you talk to the local manager, it seems like things are very much under control and they're already addressing those topics. But now 3 months have passed and still the same kind of reviews come in on the employer rating platforms. Suddenly there are challenges about regulations or new laws that nobody saw coming. And now USHQ actually have to go in, pay the legal fees or pay consultants to actually navigate these new changes in those markets. And so in many ways, you will get dragged in at some point. You will realize, I cannot fully be hands off. And that's the moment when a reckoning happens. That's the moment when, having gone from total centralization to decentralization, the pendulum now swings back into the middle. And sometimes that can be very challenging to wrestle back control into the HQ. And I always like to go by the principle of decision-making and execution can be decentralized only under one prerequisite, and that is that information and context is centralized. If information and context is centralized, if the HQ knows what's going on, and then they can also provide and grant autonomy to the leaders to make their own decisions within guardrails, ethical, legal, and so forth. We get to this in a moment. But if I have central visibility and I can hold people accountable, I can make strategic central decisions about markets, then I'm in a position where I can also confidently give autonomy of action, autonomy of execution. Oftentimes, it's actually the other way around. It's inversed, where you see that managers jump in and try to centralize decision-making, whereas they decentralize reporting and data and visibility, and everything's just held together by personal one-on-one conversations between some top leaders in the HQ or the founders and together with those local managers. And often that information is not collected anywhere centrally. and the organization is basically blindsided about what's happening in those markets. And now, not to say that people intentionally or deliberately not want to do a great job in those markets. Everybody is working at their best, and everybody wants to prove that their market can be successful. Though sometimes, due to the setup, due to the design of the organization, especially a multi-market organization, certain malpractices become an inevitable result of it. One example is, if I, as a local leader, if I'm incentivized for aggressive sales growth because the investors are pushing the founders, the central HQ, to show month-over-month growth. Now, as a local leader, I have certain marketing budget, I have a sales team. I would, of course, do everything in my power to achieve this growth. But with very little accountability or nobody really tracking my churn, my refunds, basically meaning how many of those customers can I retain, how many of them actually stay with me, or what are the customer reviews. Maybe they all write very negative things about their sales experience or interaction with the company. If nobody really looks at that, if nobody really asks me about this, if nobody even knows because it's in a different language, and nobody's really checking up on it, I might be tempted to use certain shortcuts because my job might also be on the line. I also want to show month-over-month growth, and that's the only thing I'm being asked to deliver right now. And so I will obviously do my best to maximize my results within my local context. And sometimes that will mean that if nobody asks me for it, I will not volunteer certain information that might make me look bad. And that's just because I also know if I would even raise it, if I would bring it up, nobody would care anyway. And this happens sometimes in fast-growing companies. It happens in hypergrowth. It happens when companies just got a huge funding round. There is often not the bandwidth to go into every single detail, and that makes it all the more important that, of course, conversations like information is not decentralized in one-on-one conversations, because ultimately the organization, as long as it's blind about what's going on, can never make those strategic decisions or even understand if there are issues, like, for example, the negative customer reviews, and they would never even know about it, and they could suffer an enormous brand damage in one country and even create business risks without even knowing until it happens. How do you get out of this, or how do you adjust multi-market setups when they have gone too far into decentralization, when things have become too autonomous? One piece or one element that I often found is it starts really with a psychological change, with a psychological limitation of the HQ has been scarred by using micromanagement. They have seen it doesn't work. It only creates resistance and rejection. They have seen it works better if they let people free rein. But then they also seen that doesn't work like this either, and there needs to be something in the middle. So once they get to the point of there needs to be something in the middle, the first impulse is to go back to micromanagement. I need to be involved. I need to understand what's going on so that I can make those decisions in your market about your budget, about your hiring, about how many people you should hire, about how you should lead your people, about how you should set up your sales team, about how your customer success function should run, about your accountants, your financing. So the first impulse is to go back to what didn't work in the beginning. But there needs to be a shift in terms of what we want is we don't want to go back to micromanagement. Here's the distinction between it's not about centralizing decision making, it's about centralizing information first. And what does this mean? This means that you have unified dashboards. And so often you might not think about it, but this is actually let's call it source code rewrite of a multi-market organization. Some companies in the rush of doing these expansions never really took the time to actually build the data infrastructure. It happens more often than you might think. And it's just part of the nature of growing really fast. Now, you might need to hire a couple of data engineers to actually collect all those sources, and data analysts who then actually make sense of all of this and who also make sure that there's integrity in the data. And it starts really with, do we have a unified definition of what a conversion rate is? Do we have a unified definition of what a lifetime value is? In some industries or in some products, you might not have a recurring subscription model. So how do you calculate lifetime value now if you have repeat purchases instead? Or if you have a mix of both? So there are all kinds of nuances where you need to make decisions about how do we actually want to measure things in our organization. And certainly you have universal definitions. You can, of course, draw from industry best practices, but there will be many gray zones where there is no playbook, where you need to make a decision about how you're going to measure certain metrics. And that needs to be unified. And often it takes a process of actually educating people on it, and it takes a process of getting them on board with it, including through personal relationships. There are certain things you cannot just mandate and commandeer. You need to build a personal relationship first, and to get people on board with it. Because if you do not have any visibility, and you can make a mandate and say, this is what you guys need to do, the moment you turn around, nothing gets done. If you ask about it and follow up, you'll be told, yeah, we're working on it, we're on it. Yes, we have to hit the sales results this month. Like, we don't have time for this right now, but we're on it. And you're just being slow walked. And you will find out too late that nothing was done because there was emotional resistance towards certain things that were to be implemented. For example, data collection. That's a lot of work. We don't have time for this. We need to hit our sales targets. And so we don't have a business intelligence analyst. We cannot sit there and crunch the numbers. We need to be out there and actually achieve the numbers. So there's a lot of resistance that you will never uncover if you don't build personal relationships, if you don't look people into the eye and actually sit across them at a table and speak with them about it. And video call only goes that far. And so reining or wrestling back control into central means, start shifting the way people look at numbers, the way people collect data, the way the data actually gets together in a tool, in a CRM system, in a data analytics tool. And it requires that everybody understands metrics and everybody understands which numbers to track and which numbers actually matter for their market, and based on which numbers they're being incentivized and also tracked as a market. What is the success of the market? Now, you will find that even many people with a business education will not always know intuitively what certain metrics mean. Think about lifetime value, cost of customer acquisition, EBITDA, and so forth. Think about average days to close, conversion rate, RPU, average order value. Like, whereas there are people who do this for a living and who deal with these numbers every day. It's like, how can you not know this working in a business? You'd be surprised how many times just a few metrics I mentioned to you are not even being taught in business schools. That's not even part of a basic business education in many cases. And so in many times you cannot just assume that everybody will know what you're talking about when you speak of average order value, when you speak of lifetime value, when you speak of LTV CAC ratio. People will not know. You need to educate them. And it starts with you as a leader. Because if you do not understand it, if you don't believe in it, then you won't be able to transmit it and repeatedly keep people accountable to it and repeatedly talk about it so it gets into people's minds over time, especially if you're local leaders. Now, there's one more piece, which is once you start collecting data, you start with dashboards. You now realize, okay, actually, I have some real issues in certain markets. The top line results look amazing, and that's what I always ask them for. Hit your targets, go for 150% target achievement, and I'm happy. That's all I want. But once you have unified dashboards or unified data collection and you benchmark now between markets, you will see the market that crushed their sales targets with 150% actually has a negative net profit. And so if you go all the way down to what are my costs of goods sold, what are my costs of customers acquisition, my marketing spend, my sales commissions that I'm paying, and so forth, you go through all of this, you figure out that often what looks really, really good on the top line, it can create terrible results on the bottom line, where you're literally paying money for customers to be your customers because you spend more on marketing and sales than what they actually bring in a revenue. And now let's be clear. There are certain phases in a company where this is acceptable, where it is a tactic, where I intentionally and deliberately take losses because I build market share. I say, yes, I'm totally aware that I'm losing money, but I just want to get as many people in. And then once they're in, I start upselling them, I start renewing them, and then I build my revenue with them over time. And I create multiplier effects. They refer me to other people. That's actually where I cut my cost of customer acquisition. So that it can be a tactic. But it's not a tactic if you don't even know about it, and it's not a tactic if you just find out about it and try to rationalize it post insight after you figured out that this is actually happening, and then you start making reasons for it. I actually we're building market. If it was not your strategy from the get go, now that you find out, it should alarm you. It should not be something to be justified. And once you find this out, you obviously want to change your incentive structure. You realize that probably incentivizing all those local markets by month-over-month growth can lead to very short-sighted results that will ultimately hurt the company in the long run, and also the market, because it will have to shut down if they cannot pay their salaries anymore because they're losing money on every single sale. And that was not part of the strategy. It's just something that happened accidentally. Then, of course, that market will shut down. So nobody will benefit from this. There's nothing heroic about it. And when you start changing your incentive structure, that means now you want to incentivize those local markets and those leaders for metrics like their lifetime value, like their LTV CAC ratio, like their actually net profit and their contribution margins and so forth. Those are metrics that actually help you increase your enterprise value later on, that increase the value of your company in the long run. Of course, there's a case to be made. Top-line growth with no regard to margins can also give you a certain enterprise value if you're early stage, if you're venture capital involved and they want to see certain numbers and then they pump money into your company and so forth. But this is not the reality for most companies. Often it's not that healthy either in the long run. If we want to think long-term and in the long run and with responsibility to our employees, to our investors, to our stakeholders, to our clients, then you need to change the incentive structure. And that means I now incentivize my markets based on metrics that actually help the entire company, the global company, to grow. Another piece is guardrails. And here you can take a page from the franchise playbook. Franchises operate in a very autonomous and decentralized manner. That means somebody uses the brand name and the operating manual of a big brand and starts it as a local company, starts it with their own people that they hire, and the franchise basically is borrowing certain elements of the global, let's call it HQ, of the mother company, but ultimately it's running very decentralized. But it only works because, go back to what we just discussed, there is central visibility into the metrics. There is also clear incentives for what actually means success and what doesn't. So the short-term results are typically not incentivized, but actually long-term business fundamentals and business results. You will also see that in franchises, there are very clear guidelines on brand, whereas often marketing, so basically brand meaning the overall feeling of the company, the overall positioning, what does the company stand for, that is fixed and that is non-negotiable. But then when it comes to the tactical marketing, how do I market this product in a certain geography, with a certain customer segment? There's a lot of autonomy being given. And so you already see there is, and then of course in operations you have very strict operating procedures, but also some degree of freedom of what you can actually do yourself. And you see, the franchise model is really a good model to learn from when it comes to this. There is a point to be made about guardrails. And once you have guardrails, you are less likely to micromanage. It's only without guardrails that you need to use the force of your personality, that you need persuasion, that you need to talk to every single local leader and bring them on board with you, and which often is the case in early stage companies. There's no way around it. But once you start establishing guardrails, you want to say, I would leave you free rein to do whatever you want, as long as, and then you have your list. It stays within legal constraints, it stays within ethical constraints, that the certain brand elements are always being respected. We have shared accounting and reporting structures. And now you have a couple of rules. And if those are in place, of course, if somebody cannot keep those rules, they will not have a place in the future of their company. But once you have those rules in place, you can actually take a step back from the micromanaging and from all the overstepping and being intrusive with the market. As long as you stick to this structure, I give you freedom. As long as there's unified dashboards, unified data, where I can make strategic decisions about your market and also help out if there are problems, because sometimes the markets themselves don't even see the problems. then we are good. We can work together. And then the last one, which was already mentioned, is incentives. So you want to look at dashboards, at guardrails and incentives. How do I measure success? What do you get a bonus for? What do I, as a HQ leader, tell you should do? Am I giving you a bonus for hitting your sales targets, regardless of what is happening after the sales, regardless of massive customer churn, regardless of everybody hating the product, hating the sales team, relationships, reputation being burned? Do I just say you get a top bonus for hitting your sales targets? Or do I say you get some bonus for your sales targets, but your upside is actually in your contribution margin, your cross margin, your LTV CAC ratio, and so forth. And you will see the moment you start incentivizing people differently in the same sales teams, their behavior changes. You change the economics of behavior. Now, everybody who works in a commercial organization is typically incentivized by money. It doesn't mean it's the only thing they care about, but it is a factor that shapes their behavior. It shapes what success means in a commercial organization. And if you intentionally design the incentives and say, this is what I want to see, this is what I reward financially, or even with promotions and with other means, then you will also see the corresponding results. And what you see is, instead of going back into micromanagement when you see things have gotten too far out of control, you actually build structures. And those structures, again, are your dashboards, central visibility, your guardrails, which means decentralized execution within bounds, and your incentives. What actually gets rewarded? What does success look like in this company? And you better make sure that those incentives actually serve the global company across all markets, because ultimately everybody's job and the reputation of the company depends on that.